On January 30th, 2026, the silver market didn't slide, it didn't weaken, and it didn't slowly correct. It fell straight off a cliff. In a single trading session, silver collapsed by $51, plunging from $121 all the way down to $70. $51 erased in hours. No warning, no gradual decline, just a vertical drop that stunned even veteran traders. This was the largest single-day crash in silver since 1980, a move so extreme that analysts openly called it a Six Sigma event, something that statistically should not happen within a normal lifetime of market data. Within 48 hours, more than $7 trillion was wiped out across global markets. Retail traders were being liquidated in real time as margin calls flooded in faster than accounts could keep up. Physical bullion dealers from Dubai to Switzerland reported the same thing. Zero silver on the shelves, no inventory left to sell. And while the world was watching portfolios implode and panic ripple through every trading desk, one individual was calmly positioned on the other side of the collapse, untouched by the chaos, and walking away massively profitable. Almost nobody knows his name. He does not speak to the media, does not answer emails, and has never sat for an interview. He operates quietly from a small office in Gibraltar, far removed from Wall Street, far from the City of London, and far from public attention. On that exact day, while silver was collapsing, he held the single largest short position in silver on any exchange anywhere in the world. 30,000 contracts, equivalent to roughly 450 tons of physical silver. According to Bloomberg, in an article published on February 5th, that single trade generated paper gains of approximately $288 million. After accounting for earlier losses taken while building the position, his net profit was estimated around $144 million, nearly $1 billion in gross movement from one trade. But this story is not about a mysterious billionaire making money. What unfolded on January 30th, what followed on February 5th, and what is still developing as this is being recorded, exposes a deep structural fracture inside the silver market that could permanently reshape how precious metals are priced. Later in this video, when I show you what actually happened on February 5th, including the trading volume data that came out of Shanghai that morning, you will see a data point that almost no one is discussing, and that may be the most important signal in the commodity markets right now. I will also tell you exactly who this man is, how he built his fortune, and why his identity changes the meaning of this entire event. By the end, you will understand why this matters far beyond silver alone. Every major financial outlet ran nearly identical headlines. Silver crashes, gold tumbles, Wirsch nomination rattles markets. But there is a critical detail they left out. According to CNBC, silver futures on the COMEX collapsed more than 31% in a single session, marking the worst day since March of 1980. Spot silver fell 28%. Gold, by comparison, dropped roughly 9%. Stop and think about that difference for a moment. Silver fell more than 3 times harder than gold. Both metals are priced in dollars. Both react to interest rates, inflation expectations, and currency strength. If this were simply a dollar rally or rate expectations shifting, why did silver implode while gold merely stumbled? That imbalance is the clue. It is the signal that something much deeper was happening beneath the surface, and once you understand it, you will never look at a silver chart the same way again. The official explanation goes like this. On January 30th, President Trump nominated Kevin Wirsch as the next Federal Reserve Chair. Wirsch is widely viewed as a monetary hawk, and markets interpreted his nomination as a signal for higher interest rates to remain in place for longer. The dollar strengthened, and because precious metals are priced in dollars, gold and silver sold off. Simple macro story, case closed. And that explanation is not entirely wrong. It is just wildly incomplete. At best, it explains maybe 10% of what actually happened. The remaining 90% is what makes this the most significant silver market event since the Hunt brothers attempted to corner the market in 1980. What truly happened was a violent, coordinated unwinding of leverage combined with aggressive short selling at exactly the most vulnerable moment. The data makes this clear. CFTC positioning reports showed that speculative net long positions in silver were sitting near record highs going into that week. The market was leaning almost entirely in one direction. According to Morgan Stanley, their quantitative models detected what they described as massive forced rebalancing across leveraged silver ETFs. The iShares Silver Trust alone was forced to sell approximately $3.5 billion worth of silver exposure on January 30th. That is one fund, one day. Then the CME Group intensified the damage by raising margin requirements on COMEX silver futures from 11% to 15% right in the middle of the sell-off. Mechanically, this is devastating. When margins rise during a crash, any trader who cannot meet the new requirement is immediately forced to liquidate. Those liquidations push prices lower, which triggers even more margin calls, creating a cascading feedback loop, a self-reinforcing collapse. And this was precisely the environment in which our mystery trader had positioned himself. At the start of this video, I told you one man was sitting on the opposite side of the crash, operating quietly from Gibraltar, profiting while others were wiped out. Now it is time to tell you who he is. His name is beyond shaming, and once you understand his track record, his role in this silver collapse becomes impossible to ignore. Bian is a Chinese billionaire who has made more than $3 billion trading gold futures on the Shanghai Futures Exchange since 2022. Over 4 years, he became one of the most successful metals traders alive, making billions on gold as it moved higher. And now, he has made hundreds of millions betting against silver. According to Bloomberg's February 5th report, Bian built his silver short exposure through his brokerage, Jonai Futures, on the Shanghai Exchange. Exchange data shows that Jonai's short position surged to approximately 18,000 contracts on January 28th, just 2 days before the crash. By January 30th, the same day silver reached its peak price in Shanghai, that position had expanded to roughly 28,000 contracts. On the day silver topped, he added 10,000 additional short contracts, bringing his total exposure to around 30,000 contracts, equal to about 450 tons of silver. I want to be very precise here. This is not an accusation. I am not saying Bian caused the crash, and I am not suggesting he had inside knowledge of the Wirsh nomination. What I am saying is that a trader who made $3 billion correctly calling gold built an enormous short position in silver at the exact moment the market was most overextended. According to Bloomberg's analysis, he began attempting to catch the top as early as November 2025 and took losses on several early entries. Before that, he was actually long silver, earning over 1.3 billion yuan on bullish trades back in August. He made money on the way up, then reversed his position and made money on the way down. In my view, this looks less like luck and more like experience. Silver had gone parabolic, quadrupling from roughly $30 in early 2025 to over $120 by late January. Moves like that almost always build extreme leverage underneath them. Eventually, gravity takes over. He saw the excess, recognized the imbalance, and bet that the structure would fail. But this is where the story becomes genuinely unsettling, and where I want you to pause. One trader, operating through a single brokerage, held the largest net short position on the entire Shanghai Futures Exchange. His personal trades and selected client accounts were all aligned in the same direction, and he walked away with at least $144 million while the rest of the market burned. Some estimates place his gains closer to $500 million. Was that pure skill, or was something else at play? Hold that thought, because what comes next about the physical silver market makes this entire situation far more disturbing. While paper silver was collapsing towards $70 on the COMEX, something completely different was happening in the real, physical market. And this is the point where the story stops being uncomfortable and starts becoming alarming. This was the moment that forced me to sit back and seriously question how these markets are even functioning. I have covered precious metals for years. I have seen volatility, manipulation claims, and temporary disconnects. But what happened in early February was on another level entirely. According to data compiled by multiple analysts and confirmed through exchange pricing, the same ounce of silver was trading at radically different prices depending on where you were in the world. In New York, silver was hovering around $80. In Japan, that same ounce was trading close to $120. Same metal, same day, a 50% price difference. And this was not an isolated case. Shanghai was pricing silver near $111, India around $93, Kuwait at $106, Dubai near $91, with physical premiums ranging between 15 and 18% above spot. Every major market was assigning a different value to the exact same commodity. According to financial analyst Shanaka Pereira, this marked the largest sustained divergence in precious metals pricing in recorded history. In a properly functioning global market, that kind of spread should last minutes, not days. Arbitrage traders should immediately buy where it is cheap, sell where it is expensive, and force prices back into alignment. That did not happen. And the reason it did not happen exposes just how broken the system has become. The arbitrage mechanism failed because silver lease rates exploded. According to analysis published on TradingKey, silver borrowing costs surged to roughly 7 to 8%. When you add those costs to shipping, insurance, and logistics, the arbitrage trade simply stops making economic sense. You cannot move silver from west to east at a profit anymore. The plumbing that is supposed to keep global prices synchronized has seized up. And when I went deeper into the physical market data, it only got worse. According to reporting from the Khaleej Times on January 31st, physical silver bars were completely unavailable in Dubai. Dealers said stock was exhausted, and buyers were paying up to 2,000 dirhams per kilogram above market prices just to secure metal. One dealer, Amamar Akrami of Almanar Gold and Diamonds, was quoted saying plainly that silver was not available in the market at all. Around the same time, industry insider Clive Thompson reported that one of the largest bullion dealers in Switzerland had zero silver in stock. Not low inventory. Zero. When customers sold silver back, it was immediately resold, leaving nothing available for new buyers. Even gold inventories were heavily depleted, with only large bars remaining, while coins and small denominations were completely gone. Now, I need you to connect these facts carefully because this is where the picture becomes clear. COMEX was saying silver was worth $80, Shanghai was pricing it above $100, Dubai could not supply it at any price. Switzerland had none available. At the same time, the paper-to-physical ratio on COMEX was estimated at roughly 350 to 1. That means for every real ounce of silver, there were 350 paper claims outstanding. That is not a rounding error. That is a structural imbalance. And then, just as this tension was building, February 5th arrived. What happened that morning is, in my view, one of the most extraordinary events in the history of commodity markets, and almost nobody is talking about it. According to official data from the Shanghai Futures Exchange, during the morning session alone, more than 1.39 million contracts traded on the April 2026 silver futures contract. Each SHFE silver contract represents 15 kilograms of silver. When you do the math, that single session represented approximately 674 million ounces of silver equivalent. And when you include all silver contracts traded that morning, the total volume reached roughly 1.34 billion ounces. Let that number sink in. The entire world mines about 800 to 850 million ounces of silver per year. In one morning, on one exchange, traders moved nearly double the annual global mine supply on paper. When I first saw this, I assumed it had to be a mistake. I checked the contract specifications myself. 15 kilograms per lot. I ran the calculation multiple times. It checks out. One analyst described it as the most incredible event ever recorded in Asian commodity markets, and that assessment is hard to argue with. This was not retail speculation. This was not random volatility. This was a deliberate, massive wave of paper selling designed to crush the Chinese silver price. And here is the detail that changes everything. Even after all of that selling pressure, even after dumping the equivalent of nearly 2 years of global mine supply onto the market in a single morning, Shanghai silver still closed at a significant premium to COMEX. The price was pushed down, but the premium survived. Shanghai silver remained more than $12 above COMEX prices, and within days the premium rebounded to around $17 per ounce. Silver also stayed in backwardation, meaning near-term delivery cost more than future delivery, a classic signal of physical tightness. The paper market threw everything it had at silver, and it still could not break the physical reality. That was the moment everything clicked for me. You can flood the paper market with contracts, but you cannot print physical silver, and no amount of paper selling can change that. The inventory data reinforces this conclusion. According to CEIC data, physical silver inventories at the Shanghai Futures Exchange have been falling sharply. Stocks dropped from roughly 482 tons to 455, then from 449 tons on February 3rd to just 423 tons on February 4th. That is a 26-ton decline in a single day. For historical context, SHFE silver inventories peaked at over 3,900 tons in January 2021. They are now down more than 86% from that high. This is not paper moving around. This is real metal leaving warehouses. And China's industrial demand, driven by solar panels, electronics, and advanced manufacturing, is consuming silver faster than it can be replaced. This brings us to the structural paradox at the heart of the January 30th crash. If you only follow the headlines, it looks like the silver bubble burst and the story is over. But when you examine the underlying fundamentals, they are pointing in the opposite direction. And this is where my perspective matters, because I have been tracking silver supply and demand for a long time, and what is happening now is unprecedented. On January 1st, 2026, the Chinese government officially reclassified silver as a strategic resource. That decision received almost no attention in mainstream financial media, but its implications are enormous. Only 44 companies were authorized to export silver for 2026 and 2027, covering roughly 121 million ounces per year. That represents between 60 and 70% of all refined silver traded globally. China is the world's largest silver refiner, and it just placed a government-controlled chokehold on exports. Governments do not designate commodities as strategic unless they intend to retain them. That decision alone should force anyone watching this market to reassess their assumptions. At the same time, Samsung, one of the largest technology companies on the planet, locked up 100% of the output from the La Perla silver mine in Mexico for the next 2 years through a direct prepayment deal worth $7 million. Samsung did not buy an ETF. It did not trade futures. It went directly to the source and secured every ounce the mine will produce. When a company of that scale bypasses exchanges entirely, it tells you they do not trust the paper market to deliver. They are not speculating. They are securing supply because they believe availability will be constrained. And this is the insight I keep returning to. Governments are hoarding silver. Corporations are locking up mines. Physical buyers are paying massive premiums. Meanwhile, the exchanges that supposedly set the global price are drowning in paper claims. If that does not force a rethink of how this market truly works, nothing will. And there is a timeline problem that almost nobody in mainstream finance wants to address. Even at today's elevated prices, a new silver mine takes 7 to 10 years to come online. There is no meaningful supply response possible before the early 2030s. Silver has already been running a structural deficit for 6 consecutive years, and that deficit is widening. Solar alone consumed more than 200 million ounces last year. Add electric vehicles, artificial intelligence, data centers, medical devices, and next-generation infrastructure, and the demand curve keeps steepening. There is no substitute for silver in these applications. The physics simply does not allow it. Even governments are starting to act in ways that signal something fundamental has shifted. According to a press release issued on February 3rd, the state of Wyoming selected the Wyoming Reserve as the vaulting solution for its physical precious metals holdings. AUS. State government is now actively securing gold and silver storage within its own borders. That is not a routine administrative decision. When state-level institutions begin treating precious metals as assets that must be physically safeguarded, it tells you confidence in the existing financial system is changing. These are not symbolic moves. They are preparations. Now, let me give you my honest assessment of where all of this leads. And I want to do it properly by acknowledging the bearish case first, because intellectual honesty matters. The bearish argument is clear and internally consistent. Kevin Wersch, as Federal Reserve Chair, implies higher interest rates for longer, a stronger dollar, and pressure on precious metals. Silver ran too far, too fast, and needed a correction. JP Morgan analysts have warned that silver could revisit $50. And Bian Shiming, a trader who has made billions in metals, is actively shorting the market. If someone with that track record is betting lower, that deserves respect. Silver is volatile, and the January 30th crash proved that leverage can wipe traders out in hours. None of that should be ignored or minimized. But this is where I part ways with the bearish narrative, and I want to be very direct about it. The collapse on January 30th was a leverage event, not a fundamental one. That distinction is everything. A leverage event is driven by positioning, margin mechanics, and forced liquidations, not by a sudden change in what the underlying asset is actually worth. And every piece of physical market evidence supports that conclusion. Physical silver in Shanghai never broke below $100 during the worst of the crash. Physical silver in Dubai was unavailable at any price. Physical silver in Switzerland simply did not exist on dealer shelves. The paper market said $80. The physical market said you cannot buy it for $100. That is not a bearish signal, that is a pricing failure. And the fundamentals behind that physical tightness have not weakened since the crash. They have strengthened. Silver remains in a structural deficit with no supply response possible for at least 7 to 10 years. China restricted exports starting January 1st. Industrial demand from solar, artificial intelligence infrastructure, and electric vehicles is accelerating, not slowing. COMEX inventories lost more than a quarter of their registered silver in just 7 days. London bullion holdings are down roughly 40% since 2021. Silver lease rates surged from 0.5% to 8% and have not normalized. These are not the conditions of a market whose bubble just burst. These are the signs of a market where physical metal is becoming increasingly scarce, while paper markets attempt to mask that reality. Now step back and look at the macro backdrop, because this is what solidifies my conviction. Goldman Sachs has published a gold target of $5,400. Bank of America has floated numbers as high as $6,300. JP Morgan itself has projected gold at $6,300. Historically, silver does not remain at a 55-to-1 ratio with gold during a secular bull market in precious metals. If gold reaches 6,000 and the ratio compresses to 45-to-1, silver lands between $130 and $150 per ounce. That is not speculation. That is math. My personal view, and I want to be very clear that this is opinion, not financial advice, is that this is one of the most asymmetric setups I have ever seen in commodity markets. The risk profile for leveraged paper traders versus patient physical holders is completely different. The paper market can push prices around in the short term. We just watched it happen. But it cannot create physical silver out of nothing. And history shows, without exception, that physical reality always wins in the end. So let me leave you with this final thought. The paper silver market says $77. The physical silver market says you cannot buy it at 100. One of those numbers is lying. And every time paper and physical markets diverge this dramatically for this long, it is always the paper price that eventually has to catch up. Now, I want to hear from you. Where do you think silver ends up by the end of 2026? Does the paper market continue to dominate, or does physical scarcity finally take control? Drop your price target in the comments. I read every single one, and I will pin the most thoughtful analysis I see. If this breakdown helped you understand what really happened in the silver market, share it with someone who needs clarity. Post it, send it, get it in front of people who are still confused. And if you want to support independent analysis like this, consider joining the channel. This is the hidden economy, because the real story is never on the surface. I will see you in the next one.